Good afternoon, everybody. We will. It's nice to see you all. Meet you all after a long break. No, 1 month, I think. So, how is going? Like, have you done this? Have you tried these questions which we shared at the last session? I would like to go through a few slides soon because just to just to refresh your minds, we were actually talking about uh, calculations of financial products, right? So we went through treasury bills, treasury bonds. Now these are the products actually I have selected for the calculations: bills, bonds, SLDBs, sovereign bonds, repo and reverse repo. So we went through the treasury bills and bonds, right? So we went through treasury bills very quickly. We went through. So I would, rather I will go through it again, maybe spending few minutes. Now, treasury bills are discounted instruments issued for face value, issued at discounted price, and calculated on yield, right? The price is calculated on a decided yield. And these instruments are 364-day basis and issued for 91, 182, 364 days, right? And now if we go through this calculation, I would like, if you can see this again. Now I have given this example. Now this is the formula for that. So now usually a customer or an organization would say that they want a treasury bill for this face value. They will give you an amount as the face value, and in that what you will have is you need to give that person the cash value. So what happens is you need to calculate it and then agree upon the just give me a minute. Yeah, Sankar. Yeah. Oh. All right. Oh. Oh. නෑ ඒක මේ දක්ෂික දන්නවා පේමන්ට් එක කරන දවස. ඔව් දක්ෂිකට මචං අහන්න. කමන්නේ. ෆෝවර්ඩ් කරන්න. දක්ෂිකටයි ගීතාංගිටයි ෆෝවර්ඩ් කරන්න. මචං ඒගොල්ලෝ කරන්නේ. Right. Okay. Sorry for the interruption. The person who is investing will want to know the cash value, right? So you have a face value, and the only thing they have to, or rather these two parties have to decide upon is the yield. So at what yield this treasury bill will be traded. So now, so you take this yield and do the calculation. So day count is how many number of days. The day basis is 364 because for the treasury bills we use 364 day basis, right? And now this is one example. This is the only example I gave with regard to the treasury bill calculation, but later on I thought like to explain it again to refresh your minds. A T-bill which has a face value of 100 for 90 days with a yield of 6.61. Now this 6.61 is the yield. Both parties have agreed. 6.61%, calculate the cash value. Now when you say 6.61%, now this is what? This is an annual rate. Usually we get the annual rate, right? Any instrument, when they quote the rate, you get the annual rate. 6.61 is the annual yield that they have agreed upon, these two parties, to trade this treasury bill. So face value is 100. Now you apply this face value is 100. 1 plus yield is, now why did I put 0.0661? Because now this is a percentage. 6.61 is a percentage. That is 6.61 over 100, right? So when I divide this 6.61 by 100, you get 0.0661, right? And in the sum, it says 90 days treasury bill, right? So 0.0661 is for 364 days. That is an annual, because we take 1 year as 364 day basis in treasury bill calculation, right? So what you do is you multiply this by 90 and divide the whole thing by 364, right? So thereby you get 100 divided by 1.01634. So it's 98.39. So the answer is 98.39. So you need 98.39 rupees to buy a treasury bill with a face value of 100. Now with a face value of 100, which gives you a yield of 6.61%, which gives you a yield of 6.61%. And this the tenor of this treasury bill is 90 days, right? I hope this is now very clear. So if you have anything, you can answer now or even later, it doesn't matter. But this is a very simple calculation. There's no complex calculations here, because it's one cash flow, right? You know, treasury bill, when it matures, it's the face value you get. It's the face value you get. What is your income then? Your income or your revenue out of this treasury bill is the face value minus the cash value, invested cash value. So that is your income. So in this case, if I take this example, what would be the now someone is buying this, right? Another person is selling it. So what would be the gain revenue out of this treasury bill for this person who is buying this now? 100 minus 98.39. 100 minus 98.39. So that is the gain you will be receiving at the end of the period, right? Out of this treasury bill investment. So we have to be very clear on this, because then you know the income generated, you can calculate the cash value, right? Sometimes a person can ask, okay, I have cash, this amount of cash. That also can happen, because now when customers come to the bank, they come with a certain amount of money in their account, or they bring certain amount of money. So they will say, okay, I have 100,000 cash, right? I have 100,000 cash. So what is the treasury bill I can buy from? What is the face value of treasury bill I can buy? And he will say, I expect 6.61% interest, right? So he will say, I need 6.61% interest or a return out of this investment, and I want to put it for 90 days only, 90 days. So the same calculation, then you have the face value, only you have to calculate. So then what happens is cash value into this part of the formula, right? This part of the formula, the lower part of the formula, right? 1 plus yield into day count into day basis into cash value. So easy, because then you get the same answer. Then you will be getting the face value of this investment. So it's straightforward then, right? So we will go through the other areas which we have already covered, because I thought of going through this again, because then maybe tomorrow we can do SLDB calculation as well. But today we'll spend on this to, you know, recap what we have already done, and, you know, then have a refreshed mind to do the other calculations. Fixed income securities, treasury bonds are fixed income, and they have periodical coupon interest, yield, and calculated on yield to maturity. The calculated on yield to maturity is what? The price. Now, the price is calculated on yield to maturity, right? And it's 365-day basis. 365-day basis. Now, earlier case 364-day basis. No. Now, treasury bonds LKR. Now, here I have mentioned LKR. LKR 365-day basis. Now, if I ask you what is the day basis for SLDBs and ISBs are Sri Lankan sovereign bonds. Now, these days, actually, there was a, you know, trend in investing in ISBs, international sovereign bonds. That is, international sovereign bonds are the bonds. Actually, Sri Lankan government international sovereign bonds. There can be other sovereign bonds also in the market. Especially now, these sovereign bonds are, now, since I came to this topic, I will explain a little bit here as well. So these sovereign bonds are actually issued by the government of Sri Lanka, which we are talking about now, are issued by the government of Sri Lanka, and they are listed in a stock exchange. You know, they are actually listed securities. Now, if you go to the web and, you know, if you type Sri Lanka international sovereign bonds, you get a whole lot of, you know, ISINs, you know, indicating these ISBs. Now, in the case of ISBs, now we have right now we have only dollar denominated, you know, SLDBs and ISBs. SLDBs are the same, but they are Sri Lanka development bonds, mainly issued here in Sri Lanka for the investors who are willing to buy or rather invest in US dollar investments. So these are US dollars. These are denominated in US dollars, and the day basis is 360, 360, not 365, right? Now, LKR bonds are 365. US dollar bonds are 360. But if you take sterling bonds, they are 365-day basis, right? But we don't, you know, come across them much because in our market or in our scope, we are not dealing with those type of securities. And in our portfolios also, most of the banks have SLDBs and ISBs, right? So keep that in mind. Treasury bond LKRs are 365-day basis. I know you do this every day, right? So it's a very familiar area for the money brokers. I really know, but I want to go through this just for, you know, recap what we have done already. 2 to 30 years. We say 2 to 30 years. It can be less than 2 years also sometimes, but, you know, we haven't seen in recent past very now when you say 2 to 30 years, we call them capital market instruments, because if an instrument is more than 1 year, we call them capital market instruments. So treasury bills are money market actually. Treasury bonds are capital market instruments. Now, if I take another example for a money market instrument, theoretically, this commercial paper is a money market instrument, because commercial paper is issued for 270 days, right? So less than 1 year money market instruments. Now, 2 to 30 years, when we say it's more than 1 year, so we call them capital market instruments, right? So now we were talking about this price calculation of treasury bills. I have covered this area, but I will, you know, just go through what is the basis, like what is the base for this calculation, what is the principle behind this calculation, right? So principle behind this calculation is the present value of money, right? So what is now what when we say present value of money, the theory, right? So what is it? So this bond will give you a lot of future receivables. When I say a lot of, every year till maturity there will be 2 coupon payments, right? So if it is if bond is maturing in 6 years, you will be getting 12 coupon payments, and finally with the last coupon you get the face value as well. No, now bond is traded for the face value, no, right? Bond is traded for the face value, calculated on the yield to maturity, calculated on the yield to maturity. So that is how this market operates, and yeah, based on required YTM. So this future we calculate, very basically we calculate the present value of all these future receivables. That's it, right? So we did actually few calculations. We did few calculations. Now, how did you fare? Like, did you go through these calculations? And before I, I can explain other calculation and make you comfortable. But before that, just tell me whether you have any difficulty in understanding any of these areas. Up to now, now I have gone through few areas again today. Now tell me any other thing that you want to know, or just speak up a bit. Then it will be easier for us to understand, and also for me to explain in a very productive way, because when the interaction is there. So if there's anything, right, you can ask now. Otherwise, I will move on to this. Move on to another calculation. So now, yield to maturity, there can be different, different explanation for that, or a different type of thinking behind this yield to maturity. But basically, if you keep the bond till maturity, right, this is the rate of return that you will be getting out of its cash flows. So so many definitions are there, but all are the same with regard to the return you get, and with regard to the period that you have to keep it, or rather you have to hold it. So if you hold it till maturity, then out of these cash flows, this is the rate of return. You can call it the internal rate of return as well, but rate of return that you will be getting. So that is why it says yield to maturity. Now you have to keep it till maturity. Otherwise, the calculation, you have to do the recalculation. If you sell it, halfway through, if you sell it, and when you sell it, what will happen? If you sell it this halfway through, you will have capital gains, no, or capital losses. Now, usually we try to sell. Now we don't keep the bonds till maturity. Now, in a maybe say once we finish it, we will be doing about these portfolios in an organization, right? So, but I will explain a bit here. Now, when you say when I say that we don't keep all the bonds till maturity, now banks and other investors, they have different portfolios. You call them now, one portfolio is held to maturity. We call it HTM, held to maturity. Another one is they call fair value through marking to market now, but we very commonly call it trading portfolio, right? The other one is AFS, available for sale, right? So there are certain rules governing these portfolios. When you transfer securities to these portfolios, we have you know we have different scenarios uh, to make a decision on which portfolio that we are going to have a security, right? So now in this definition we say yield to maturity is the investment in a bond if the investor holds the bond until maturity. But even though we don't have any intention of keeping it till maturity, that is when we buy the security for the trading portfolio, right? So when you buy the security for a trading portfolio, you don't have any intention of keeping it till maturity, right? So that doesn't mean that we deviate from this calculation, right? The same calculation we use, right? So although the desire or the intention is different, the calculation is same. So because one can have now this area I haven't touched earlier. So one can wonder whether now okay, now if they are buying to the trading portfolio, right? And if they are not keeping it till maturity, keeping the bond till maturity, right? Why do they want to use this concept, right? Why do they want to use this concept, right? Uh, when the intention is not so, in the sense not to keep it till maturity, not to keep it till maturity. But our principle won't change. The principle is the future sorry the present value of the future cash flows, the present value of the future cash flows. So and you calculated based on a yield, right? So that is the yield that at that time a person would expect to have, right? Person would expect to have as his return for this investment, as his return for this investment. So although our intention is different in trading portfolio, the calculation methodology is the same, right? So so if you have any doubts now, I think those are cleared. So so this is only when we say yield to maturity, this is a definition which will elaborate what is meant by yield to maturity, right? So so the point here is, even if you don't keep it till maturity, our calculation methodology is the same, right? So so we get the coupon payments. We have gone through that. We get if it is a government security. Usually they are semi-annual coupon bonds, semi-annual, and most of the corporate bonds, actually worldwide, the semi-annual coupon is the most popular one. Semi-annual coupon is the most popular one, and there can be other coupon periodic periods as well, like maybe say 1 month or 3 months. 6 months, 12 months, like that. 6 months is semi-annual anyway. 12 months, like that. There can be other, variations as well, right? But mostly we see semi-annual, semi-annual coupon payments, right? So now this calculation we did. Uh, this is what I have already just now explained. So shall we? Now we did all these calculations up to this point, no? So now we have another area here, right? After this, when you calculate, you get the clean price, dirty price. You get clean price and the dirty price. You know these terms. So clean price is the price of the bond, right? Without considering what? Without considering the accrued interest, right? Without considering the accrued interest, if you take the price, that is the clean price, right? So now you add accrued interest, right? You add accrued interest to the clean price, and then you get the dirty price. So dirty price is the sales or purchase consideration. So the trade will happen, or trade concludes at this amount or at this consideration. So the buyer will have to pay the seller the clean price plus the accrued interest. Clean price plus the accrued interest, right? So now if you say, if I ask you why this accrued interest comes into the, into this whole transaction. Now, what is the reason for this accrued interest to, get into this transaction? Now, on which day, if you do a deal, that there won't be any accrued interest, right? So these two questions, you just think. Now, if we do this deal on value on coupon date, right? Value on coupon date, there won't be any accrued interest, right? If you do a deal value coupon date, so there can be, say, a bond issued on 1st of January, we will say. So 1st of January, the next coupon date is 1st of July. 1st of January and 1st of July. 1st of January and 1st of... So if someone sells this bond on 1st of July or 1st of January, right, what will happen? There won't be any accrued interest. So the clean price is the price which will be taken as the consideration for this transaction, right? That is the settlement amount for this transaction. If they are, say, we do this deal, right? I'll open the slide, then it will be easy, right? So if we do this deal just one day after the coupon payment, we will say we do this deal one day after the coupon payment, right? So then there will be accrued interest for this bond. There will be 1 day's accrued interest, right? You got my point. There will be 1 day's accrued interest. So the seller will ask for that accrued interest as well. Seller will ask for the price, the clean price plus the accrued interest. Now you get here, clean price of the bond plus accrued interest is the dirty price of the bond, right? So dirty price is the total purchase consideration for this transaction, right? So buyer will have to pay accrued interest, right? Why buyer has to pay accrued interest? Because this interest he will be getting in his next coupon receivable, right? When he receives the next coupon, he will be getting this interest also inside that coupon. So, I mean, in this transaction, once it is concludes, it concludes. You can't, say buyer can now. The otherwise, what will happen? Buyer can say, okay, I will pay you the interest, accrued interest, but when I get it from central bank, right? When I get it from central bank, I will pay you. But that is a bit complicated situation, right? Once the deal is done, the security is given to the buyer, right? And thereafter, there is no obligation between these two people, right? Once the deal is done, right? Not like any other things, like sometimes, other assets, not like financial assets. Other assets, there can be, different types of obligations coming in uh, after the transaction is concluded. Maybe, right, okay, maybe someone sells a house, right, and then later on the buyer finds that there are certain defective equipment or items in the house. So then that obligation is there, so they have a separate agreement to cover these. Most of the cases to cover these, maybe they will give you a guarantee for 6 months or something like that. But now in these financial instruments, you can't have such obligations coming in later on, because then the transaction efficiency, right, would be, or the market efficacy of the market would be very, very low, in the sense, there will be a lot of transactions which have not fully concluded, right, because they have to pay the accrued interest payments are due from the buyers to the sellers. So this is not, this is this will not contribute towards development of a good market. So as such, in bond trading, we have a different practice and different regulations for this. So the buyer will have to pay the dirty price at the time of purchase with the clean price. So clean price plus accrued interest is the dirty price. So he will pay the dirty price, that is the clean price plus the accrued interest portion. So I think you are clear on this. I'm just recapping everything again, because we met after a long time. So we went through these bond calculations. I think some important points. Right. Okay. So how do you feel? Shall we do one more calculation? Right. One more calculation to see whether we can, do something on our own. Right. I will select a calculation. This we have already done, no, right? Okay, just a minute. How about this one? You can see the screen, I hope, right? This is the sum. Did we do this? This one. Right. So now you see this some part of the answer is also there. Anyway, it doesn't matter. Now this is a bond which has a face value, right? Face value of 50 million. Settlement settlement date is 11/10. Actually, this month has come first. I will change it. It will be easy. So last coupon was 9/1, right? So shall we try on this? So 50 million is the face value. This will be settled on 11/8/2010, right? And issue date is 1/3/2010, right? So why this settlement date? Settlement date is after the issuance, there will be another transaction taking place now, right? So another transaction taking place now. So that is, so we have to assume that we are on August 11th, right? We are on August 11th, and issue date is 1/3/2010, and maturity date is 1/3/2014, right? So this is a 4-year bond, and the coupon rate is 7%. Coupon rate is 7%. Yield is 9.32. Yield is 9.32. So the last coupon is, right? Last coupon is 1/3/2010. Why I say last coupon? Actually, this need not be there in the sum, because you can calculate this, because before this settlement date, right? Now it was issued on issue date was 1/3/2010. No, so when I say last coupon, right, that was the issue date anyway. There wasn't a coupon, right? This is the next coupon is 19/2010. 19/2010 is the next coupon date, but there wasn't a coupon before that, so we take the issue date as the last coupon date, right? So it was the issue date. So you have to calculate now the price of this bond, right? So how do we calculate the price of this bond? So first we can, the first step is we need to know how many cash flows, right? I will show you how many cash flows. Now there are 8 cash flows. Why 8 cash flows? These are the cash flows actually, right? Why 8 cash flows? Because this is a 4-year bond. 4-year bond. So there are 8 cash flows, right? Now I will be explaining this by using this spreadsheet as well. So the answer is anyway, it's there. So you can go through while I'm explaining, just try to go through, right? So now we need to know how many cash flows. So we need to get the present value of all these cash flows, right? Present value of all these cash flows. So present value on which date? Present value on which date? Present value on this date, right? This is sorry, right? Present value of this date. So I will highlight it. So this is actually 11th. This there's a small formatting issue. Okay. Okay. Then I will explain this. So the, on 11/8/2010, right? On 11/8/2010, right? Right. So this is the issue date. The maturity date is again 1/3 2014, right? So last coupon was 1/3/2010. Why I say 1/3/2010? That was the issue date, because thereafter this we haven't received even single coupon on this one, right? So first coupon you are going to get on 1/10/2010. Sorry, 1/9/2010, right? That is after the issuance after 6 months of 1/3/2010, right? So we need to calculate. Now we need to calculate the N actually. Now N and R we know. What is the R? Yield 9.32%. So when we say yield 9.32%, right? 9.32% yield, that is for 1 year, right? Now listen carefully. I am explaining this sum, full sum now. So after doing this, we will be moving to a new section. So we won't be covering this area again in this depth, right? So I am doing one more question. Fully I am explaining to you for, as a, so you can, be more comfortable in these calculations. Now 9.32 yield, right? This is the yield at which this trade will take place. This is the yield at which this trade will take place. So in other sense, this is yield to maturity, right? This is yield to maturity. Now we need to know the coupon rate to calculate our coupon interest. So coupon rate is also given here, right? Coupon rate is also given here. This purplely highlighted one just now I highlighted 7%. So coupon will be 50 million into 7% divided by 2, because half year divided by 2. So it will be 1.750. So the coupon is 1.750. I will make it. You can see it clearly. Right, okay. 1,750,000, right? By coupon rate is for 1 year, right? Half of it only you will be receiving for 6 months. That's obvious anyway, but keep that in mind, because sometimes in the calculations, if you go to do these calculations manually, sometimes you forget to divide it by 2, right? So now we need to know the day count. Why do we need to know the day count? Because we need to calculate what? We need to calculate the accrued interest for this. Accrued interest, right? So accrued interest we need to calculate. So we need to know the day count. And accrued interest for how many number of days? Now in the early explanation, I was explaining just after 1 day of the coupon, you get 1 day's accrued interest, right? So in this case, now this accrued interest number of days are, how do you get these number of days? You calculate from the issue date to this settlement date, from the issue date to the settlement date, right? And then you need to calculate the full coupon period also from the issue date to the next coupon date. So we will do that calculation also here. Right. So now just tell me now, when you do issue date, right? It is issued on 1st of March. No, it is issued on 1st of March. So do you take first also? Yes, because it's issued means at the end of the first day also it's there in your portfolio. If you have bought it, it's there in your portfolio. So you take 31st as well. I'll just do a calculation here. 31st is there. 30th April you have to take, and 31st March you have to take. Sorry, May. 31st May you have to take. 30th June you have to take, and then 31st July you have to take, right? 31st July you have to take. Then 31st August you have to take. And what else? 31st August you have to take, right? August month you have 31 days. But the coupon is 19. So in this calculation, do we take the starting date for the previous calculation? No, we don't take, because we have already taken the start date here. The end date is 31st August. So up to 31st August, interest will be paid on next coupon date, that is 19/2010, right? Up to 31st August will be paid on next coupon date. So coupon will be paid on this date. You know, the coupons are paid on the coupon date, but that is until the previous day, only, right? Not inclusive of the payment date, right? So this date will get, included in the next coupon, right? So we will just calculate this on the same thing. So 184 days. So that is how I took this 184 days, right? You see 184 days. So this is the calculation. I will mark and I will share this also with you. Then you will know how we have arrived. So we will mark it in a different color, right? So accrued interest is calculated like that, right? Sorry, the day count, number of days for this current coupon period, and accrued interest number of days we will calculate from issue date to the settlement date, right? So that also we will calculate. Shall we calculate it here, right? Okay, issue date. So issue date is 1/3/2010. You get 31 days, right? Then you get 30 days. Then you get 31 days. Then you get 30 days, and you get 31 days. This is wait. I will put here, right? Okay, 31 days. 30 days for April, 31 days for May, and 30 days for June, and 31 days for July, right? So this is March, right? April. Follow the calculation, right? May, June, July, and okay. So now we have done up to July. We have done up to July. So now, do we have to include August also? No, we don't have to include August. Why we are not including August? Because August 31 we can't include. However, the settlement date is 11. So if the settlement date is 11, right? If this date is 11, then what happens? up to 10th, you have to include up to 10th. So you include August 10 days, right? Only 10 days in August, right? So we will calculate it and see whether we get this. Yes, we get 163. So 163 accrued interest, right? So that calculation, I hope everyone understood this, because now I am actually doing it in a bit different way than earlier, but same same methods being followed. So now 163 days and 184 days, we have got the calculations. The day count 164. Day count means day count for the current coupon period, right? Then accrued interest. So now you know how to do this, right? 1,750,000 into, we can do it here, right? Okay, we will do it here. I don't think that 163 divided by 184. We have to format this. Right, so you get the accrued interest 1,550,271.74, right? 1,550,271.74. But this is correct. This is correct, but this is theoretically correct, but practically we were doing it in a different way, and in the market also we are doing it in a slightly different way. Same data is used, but we first do this. We get this accrued interest fraction. How do you get there? How do you get this? You get this by doing what? You don't get this coupon interest first, right? So what you do is you have a different way. That is, you first do this part. Shall I show you the earlier one, or do you want me to do it? I'll do it somewhere here. Right, okay, how to do this accrued interest calculation. Now this is there. Now right, so now what is the how do we get this one? Now we used this coupon interest into 184 and 160 into 163 divided by 184. Why? Because there were 163 days accrued interest is there, and for the period there are 184 days, right? So that is how we got this. But now to get this, there's another part. No, to get this 1.750, you have to multiply 50 million by 7%. You have to multiply 50 million by 7%, or rather, we can say 3.5%. That is 3.5 divided by 100, right? Into 163 divided by 184. So I will do this calculation here somewhere here, right? 3.5. If you don't understand anything, just ask, right? Divide by 100 into so you get this answer, right? You can see this answer here. Copy it here. Right. Okay, you get the same answer here. Now, what did I do? I did this part of the calculation first, right? I did this part of the calculation first and got some, figure here. So otherwise, what can I do? Otherwise, I can do this 1.750. That is this part only. That is 50 million into 3.5%, right? Or 7% divided by 2. So I straight away took 3.5. It's straight division, no? So I took 3.5. So you get 750. 1,750,000. But now if we calculate this, our formula is just a minute. You copy it again here. Now our formula is the 50 million, right? 50 million. Sorry, 50 million into, right? So you got that one. Now say for currency. Right. So same answer you get. Now what is this one? 50 million. 50 million into 3.5% into 163 divided by 184. So what I did here was 1,750,000. I multiply by 163 and divide by 184. So you get the same answer. So here what we do is we take only this part and we get a fraction like this. So this one we take it for 6 decimals. And this amount we multiply by 50 million. Same way, but only thing you first do this part, the latter part. You first do this part without taking into the consideration the face value, and you get this fraction, and this you multiply by 50 million. Then you get this figure. So you can I will again do it here. Plus 50 million into this, right? 50 million into this, right? Then what will happen? Then you get this answer. You get this answer. You see, now you get this answer. So this is 50 million into this. So practically when we do, just to avoid any ambiguity in our calculation, so otherwise what will happen? Otherwise seller will say, no, my calculation has 1 rupee more, right? So the buyer will say, no, it's wrong. So to avoid such situation, we do this practical approach to arrive at accrued interest which both parties can agree upon, right? So accrued interest calculation is like that, not very complex, but you have to understand a bit here why we do it. Otherwise, for the theoretical purposes, this is more than enough. 1,750,000 into 163 days divided by 184 days. Why? This 1,750,000 is meant for 184 days. This 1,750,000 is meant for 184 days, right? But now we are selling it after 163 days, right? This 1 million is meant for this. We are selling it after 163. So I should, if I am the seller, I should get interest for 163 days. So straightforward calculation. If 1,700,000, if 184 days gives give you 1,750,000, what is the amount that you will be getting from 163 days? So straightforward calculation, you get 1,550,271.74. Here what we did by adopting a different methodology, we have fine-tuned this to suit our practical calculation or suit our market, right? So that's there. So you get 1,550,271 as the accrued interest, right? So now here I have explained you.
So the accrued interest is correct, no?
Sorry.
So you took that 0.031005, but you take is when you calculate the accrued interest 0.030005. There should be a 1 after the 3.
Just a minute. Here, no?
Yes.
Just a minute. We will put. No one will realize that. Yeah, sorry. Yeah, correct. Yeah, that is why it's a bit good that you identified it. Actually, we have to take 031 00. You can take up to, we said up to 6, no? So you can take, right? So this should be the accrued interest, right? So if we take for 6 decimals, this should be the accrued interest. There's actually this is wrong, because now you know that now this cannot be. Now here early answer was 1,500,000 to 700, no, right? So this is 1,550,000 to 700. There cannot be such a huge difference, right? There's actually maybe about, say, 48,000 difference, no? Yeah. So that is because now when I copy this amount, I haven't copied it, I have just typed it here. That is why it has got a different answer. Sorry, Void, thank you for pointing it out. I will change this as well. We can delete this because we have the correct figure. No, so 1,550,250. So here 1,550,271. So we make it a point to take it for 6 decimals for us to get the exact accrued interest, or we can use, it depends on how your market use these decimals. Now here I have taken for 6 decimals, right? Now it can be there's no hard and fast rule that you have to take it for 6, but right now our practice is that. But the only thing, we don't do daily calculations on these accrued interest and bond prices manually, no. So this concept is embedded in the systems and the bond calculator, right? So we can from the bond calculator, even now this entire calculation carries this wrong value, so we can make it correct. Don't worry about it. I will put it here, 1,550,250, right? Yeah, also the same thing. Right. So we will, when we go up to that, we will make the corrections. right? So so this is the accrued interest that is for number of 163 days, 163 days. So if you take 1 day's interest, that is 1,750,000 divided by 184 days, right? So that then you get 1 days. So likewise here what we do is we multiply it by 163 and we got this theoretical calculation, but we have fine-tuned it here by using 6 decimals, 1,550,250, right? So then we move on to the main calculation, that is the calculation of present values of future cash flows, right? Present values of future cash flows. And for that we need to calculate, now in our formula we need to calculate the n value, n, right? So we need to calculate the n. So how do we calculate n? So we need to calculate. Now we know the n for the full periods, right? Now this has full 7 coupon periods. This bond has full 7 coupon periods plus a broken period. Why it is broken? Because this transaction had taken place within a coupon, not on a particular coupon date. This is in between a coupon period this had taken place. So we have a broken period, that is now the first coupon will be received in how many days? The first coupon will be received in now we have here 184 days. Now already 163 had gone. How many more days? How many more days? 21 days, no? In 21 days, you will be receiving your first what? First coupon. You will be receiving your first coupon. We will just see 21. Without making the calculation, we will just see 184. Right? So you have to try these calculations and see, right? Now I have put more decimals into this. Now only thing I can't expand it here because we'll copy it there in others also will get expanded, right? Right. So now what I have done here was I wanted to get the broken period. Now if we take one n period, right? Sorry, if we say one full coupon period, n value is 1, right? We say one full coupon period, n value is 1. There can be a different number of days for these 7 coupon payments, right? There need not be the same number of days, but since the coupon payment is equal, now in this bond market, right? In our bond market, even in other countries, there can be now when we say bonds, these are actually conventional vanilla type of bonds, we say. So in these conventional bonds, the coupon is equal, right? Coupon is equal, but there are, as I think I have mentioned this earlier also, there are some bonds which are not conventional, right? There can be different features or different attributes added on to the bonds, right? So there can be slight differences in those features of those bonds. But now in this conventional bond, we have to we should know that although the number of days are different in different coupon periods, you get equal coupon payment, right? Now in this case the coupon period payment is 1,750,000. No, so all these 8 coupons you get 1,750,000. But in the case of calculation, accrued interest calculation, right? In the case of accrued interest calculation, you take number of days. So that is for the number of days you have to calculate, because you have to exactly calculate. But if you keep a bond for one full coupon period, you get the full coupon. So then we don't calculate, say maybe now during this period there are 184-day coupon periods and 181 days, right? There can be 182 and 186, right? You just calculate and see, right? During this tenure of this bond, there are coupon periods which have 184 days and 181 days, and there can be a one for 182 days also. If it is a leap year, then you get 29 days in February, because one coupon actually falls, this 181 falls within this leap year thing, like the February. So then you get 182. So the entire, if you take, actually 186. But for the 181 and 182s also, you get 1,750,000. Not, we don't calculate according to the number of days. So the equal coupon, right? So here, we consider n is equal for one full coupon period, that is 1. So we consider n equals 1 for one full coupon period, right? So n is 1 for one full coupon period. So then we need to know, now in this case, since there's a broken period, right, which starts on 11/8/2010, now going up to 1/10/2010, we are worried about the next coupon. So next coupon will be received in 21 days, right? So if 184 days equal to 1, right? If 184, now in this, when you do a calculation for a broken period, accrued interest or N or whatever it is, you have to take exact number of days. That is 184 days for the coupon, and for the current coupon, it's the running coupon, no? And 163 days for accrued interest, right? So so you take the exact amount, number of days. Now for the calculation of N, you will be receiving your next coupon in 21 days after the settlement. 21 days after settlement. So that means you have to bring this coupon, right, from future to present. 21 days you have to bring it. So 21 days. So that our calculation that this 21 days is a very important thing, because every coupon will come the full periods plus 21 days. Full periods plus 21 days. So we need to know the fraction of that. So the fraction which applies for this 21 days. If 184 days is 1, right, then 21 days is what, right? If 184 days is 1, then 21 days is what? So here what I did was, now already I have calculated it, so I am again calculating it, and then what I got here is, what I did here was 21 divided by 184, right? So that is, if 1 is 184, then 21 is what is the fraction of the period, right? What is the fraction of the period that you have to taken into consideration in this calculation, right? So so this is it. So you get 0.114130, right? So you get 0.114130, right? So here also we will take 6 decimals. So you get 0.11413. So 0.11413, and here you get your R, right? So I will let's put this some different color input, right? So here you get your R. R is 4.66. That is, you get half of the yield to maturity. Why you use half? Because now we have taken 6 months, the semi-annual period, as one period, right? So our calculation should be based on that. When we base our calculation on that, everything should be adjusted for 6 months, or everything should be adjusted for this semi-annual period, right? So n we took n, and here now this coupon 1,750,000 coupon is also adjusted for semi-annual period, that is for 6 months. No, otherwise how much will you get? You get 3,500,000, 3,500,000, but half of it only you have taken. So here R also you have to take half of it, right? Half of it is 9.32 divided by 2, 9.32 divided by 2 and divided by 100, right? Because this is a percentage. So then you get R equals 0.466, right? 0.0466, right? So now we have all the data with us. So, or the attributes which we need to apply in that formula. PV equals, what is the formula? PV equals FV divided by 1 plus R into the power n, right? This is very very simple formula which you can remember always. If you remember this formula, right, it will be helpful in so many ways, right? Because this calculation is used for different purposes, right? Even for other, if you want to value a project, even this is important. So PV equals, that is present value, equals future value. Now when we say FV, it's future value, right? Because sometimes we use FV for face value as well. This is not face value we are using, we use future value. Future value is what? Future cash flows, right? Future cash flows. So future value divided by 1 plus R into the power n. Now in the first calculation, n is this, right? Now further calculations. So now here, now these are coming, this last one, it's coming 7 full periods plus this part of this period, that is this fraction of the period. So 7.11413. So this this one, right, we can say the coupon. We will for the easy this thing, we will name this first coupon, second coupon, third one, fourth one, fifth one, sixth one, seventh one, and eighth one, right? So 8 coupons are there, no? Right? 8 coupons are there. So 8th one is coming 7 full periods plus 0.11413 period, right? The 7th one is coming 6 full periods plus 0.11413. The sixth one is also the same, 5 plus this. So they are coming, but full periods plus this fraction. So the first one we are about to receive in 21 days are coming from 0.11413 periods, right? Or it's 0.11413 periods away from us, right? So we have to bring it and apply in this formula and get the present values, right? So I have done this. Now here actually the date format has changed. It's 9, so shall we try to change it? So we'll use this, then it will be easier. No? Okay, right. Okay. 1st September, 1st March, 1st September, 1st March. Likewise, it goes up to 14, 2014. These are actually real deals I have taken without, by deleting the other information. So these are real deals which you can, that is why this. I have taken this some old ones. That is why these 2010 and 14 ones are there. So 2014, 1st September 2010 up to 1st March 2014, we have 8 cash flows. So the cash flow values are here, right? And this is there, right? This is the what? This is the dirty price of the bond. Actually, in this calculation, you straight away get the purchase consideration, or the consideration. We can say consideration, right? Consideration for the trade, right? So this is the consideration. So the seller will get this amount, the buyer will have to pay this amount, and the price is 96.2029. How did I get this? By dividing this by, I'll tell you, 50 million, so 48 million divided by 50 into 100, right? Because we want to get the price for 100 face value, right? So you get this if you expand now. So we will so 96.2029. So usually we give for 4 decimals the price. So you get, so how did I take this? I divided this by 50 million and into 100, because I wanted to get 100 face value, 100 face value bond price, right? So you get dirty price 96.2029, and then here we have this accrued interest adjustment, and we get the clean price. So this part we need to recheck because we actually there was a slight error here. So what I request you to do is straight away I will email this part to Menaka. Then he will send it to you all, or rather it will be available for you to view. And please do this calculation tonight and try to arrive at these figures. So if you can arrive at these figures and arrive at the dirty price and the clean price, then we are through, right? Then we don't have to worry about if you can do this. So I will I will mail it to you, or rather I will put it to the IBSL, then they will do the needful. So please do the calculation and come. We will take 10 minutes from tomorrow's time to, or 10 to 15 minutes from tomorrow's time to explain this part, and you know, start on other things like, you know, the SLDBs and ISBs, right? So we will stop now and then call it a day, because thanks for agreeing for the advance time. Maybe tomorrow also we will be able to do at this time, right? If there's a change, I'll let you know. I'll let IBSL know. Thanks for listening.